Hello everyone, this is Dr. K. Jagannayaki, Professor in MBA Department, Institute of Aeronautical Engineering, Hyderabad. Today I would like to discuss with you all about financial analysis, under which I would like to focus on ratio analysis. After going through this topic, the learner will be able to understand the meaning of ratio analysis, what is the importance of ratio analysis, advantages and limitations of ratio analysis, and what are the different categories of ratios. So let us start with the introduction. So Alexander Wall is considered to be the pioneer of ratio analysis. So he presented the detailed system of ratio analysis in the year 1909 and explained its usefulness in financial analysis. So it is one of the important technique of analysis and interpretation of financial statements. So it is also used to analyze various aspects of operational efficiency and degree of profitability. So based on different types of ratios, we can able to analyze the financial status of a company. Coming to the meaning of ratio, a ratio is a figure expressed in terms of another. It is a mathematical relationship between two items expressed in quantitative form. When a ratio is explained with reference to the item shown in the financial statements, and it is known as accounting ratio. The ratio analysis facilitates easy understanding of financial statements. So this ratio analysis is also useful to compare various companies' financial status, and within the company, if you take different kinds of inputs like profitability, one can understand what is the profitability position, solvency, and liquidity position of the company. Whereas ratio analysis is a quantitative method of gaining insight into a company's liquidity, operational efficiency, and profitability by studying its financial statements such as the balance sheet and income statement. It is a cornerstone of fundamental equity analysis. Then coming to the advantages, importance and significance of ratio analysis, it is an important technique of financial analysis. It helps to analyze and interpret the financial health of the enterprises. It is also useful not only to confine to business managers but also it extends to various interested parties like government, creditors, employees, investors, consumers, etc., who also consider as the stakeholders of the business. Coming to the limitations of ratio analysis has the following limitations. One is limited use of a single ratio, lack of adequate standards, lack of comparability, inherent limitations of accounting, changes in accounting procedures, window dressing, price level changes, personal bias, ignoring qualitative factors, reliability of data. So, coming to the first one, limited use of a single ratio. A single ratio doesn't convey meaningful message. As such, a number of ratios will have to be calculated for a better understanding of a particular situation. So, a series of ratios computed may create confusion. So, ratios can be useful only when they are computed in a sufficient large number. Calculation of more ratios sometimes confuses the analyst than help them. Second one, lack of adequate standards. So, expecting a few situations, in most of the cases, universally accepted standards for ratios are not available, like how we have for accounting concepts and conventions. So, it renders interpretation of ratios is somewhat difficult. Lack of comparability. The results of two firms are comparable with the help of accounting ratios only if they follow the same accounting methods. So comparison becomes difficult if they follow different methods. Similarly, utilization of facilities, availability of facilities, scale of operations that affect the financial statements of different firms. So everything is same, then only they can able to compare one company with that of another. Otherwise, it is a difficult task for the companies to compare with the accounting ratios. And next, inherent limitations of accounting. So, accounting records contain historical data. As such, ratios based on data drawn from accounting records also suffer from the inherent weaknesses of accounting records. The accounting ratios of the past may not be true indicators for the future, because whatever limitations with the accounting, as we used to take the financial data from various financial statements, the same data you are going to use in the computation of ratios. So the same limitations inherited even in case of ratio analysis. The next, changes in accounting procedures. So change in accounting procedure by a firm often makes ratio analysis misleading. Different types of organizations may follow different types of accounting procedure. For example, service sector, they will have their own procedure. If you take insurance companies, they will adapt their own accounting procedure. A manufacturing concern may have a different types of accounting procedure. So, for example, a change in the valuation of methods of inventories from FIFO to LIFO increase the cost of sales and reduces the value of closing stock, which makes inventory turnover ratio to be impressive and an unfavorable gross profit ratio. So it depends what type of method we are going to use to analyze the data. Based on that, we can also find changes in terms of ratio analysis. The next one is window dressing. So, window dressing in accounting means an effort made by the management to improve the appearance of a company's financial statements before it is publicly released. So, it is somewhat like a manipulation of financial statements to show more favorable results for the business. So, financial statements easily be window dressed to present a better picture of its financial and profitability position to outsiders. For example, if an investor want to invest in a particular stock, so just by analyzing the financial statements by way of assessing the risk and return they used to invest, if the financial statements project a sound financial status, based on that investors will also invest in that stock. So if they do not make this kind of window dressing, then that leads to losses to the company. So hence one has to be very careful in making a decision from ratios calculated from such financial statements. It may be difficult for an outsider to learn about the window dressing made by a firm. Next, price level changes. Since ratios are computed for historical data, no consideration is made to the changes in price levels, and this makes the interpretation of ratios invalid. So, whatever we use to compute the ratios based on the historical data, past data. So, as a result, the present status of the business we cannot assess, and whatever ratios interpreted by us, they prove invalid. The next, personal bias. Ratios are only means of financial analysis and not an end itself. So they have to be interpreted, and different people may interpret the same ratio in different ways. Ignoring qualitative factors. So ratio analysis ignores the qualitative factors which generally influence the conclusions derived, because it is a mathematical expression, so which can be expressed in terms of quantity, in terms of figures. Next, reliability of data. The accuracy and correctness of ratios are totally dependent upon the reliability of data contained in financial statements. So, if the financial statements are accurate, then we can able to compute accurate ratios. If there are any mistakes or omissions in the financial statements, then ratio analysis present a wrong picture about the concern. So these are some of the disadvantages with ratio analysis. Coming to the use of ratio analysis. So ratio analysis is useful in different ways, comparing the financial performance. So one of the most important thing about ratio analysis is that it helps in comparing the financial performance of two companies. Then second one is trend line. Companies tend to use activity ratio in order to find any kind of trend in the performance. Trend means it tells us about the general tendency of the business activity. So companies use data from financial statements that is collected from financial statements over many accounting periods. So last 5 years and 10 years trend if you want to project that can be possible with the help of ratios. So the trend that is obtained can be used for predicting the future financial performance. And third one, operational efficiency. Financial ratio analysis can also be used to determine the efficiency of managing asset and liabilities. It helps in understanding and determining whether the resources of the business is overutilized or underutilized. So with the help of the total assets and liabilities, we can able to analyze the resources of the business, whether they are underutilized or overutilized. The next classification of ratios. According to the nature of accounting statements, we have three categories. First one, balance sheet ratios. Second, profit and loss account ratios. Third one, combined or composite ratios. Coming to the balance sheet ratios, these ratios deal with the relationship between two items appearing in the balance sheet. For example, current ratio, liquid ratio, debt equity ratio. So these things we can see in case of balance sheet. And second, profit and loss account ratios. This type of ratios show the relationship between two items which are in profit and loss account itself, such as gross profit ratio, net profit ratio, operating ratios comes under this category. And third one, combined or composite ratios. So these ratios show the relationship between items taken from profit and loss account and the other from the balance sheet. Examples: rate of return on capital employed, debtors turnover ratio, creditors turnover ratio, stock or inventory turnover ratio, capital turnover ratio, etc. So that type of ratios are known as combined or composite ratios. And second, classification from point of view of financial management or objectives. So financial ratios can be invaluable to investors making decisions about companies in which they might want to invest. So, a variety of ratios is used by individual investors, institutional investors, and professional analysts. So, typically, the financial ratios are organized into four categories. First one, liquidity ratios. Second, solvency ratios. Third, valuation ratios or multiples. And fourth one, profitability ratios. Coming to the first one, liquidity ratios. So these ratios are an important class of financial metrics which are used to determine a debtor's ability to pay off the current debt obligations without raising external capital. So that can be assessed with the help of three ratios. One is current ratio, second quick ratio, third absolute quick ratio. So the formulas are like this: current ratio is equal to current assets by current liabilities. So current assets are those which can be easily marketable, which can be easily convertible into liquid form. The second one is quick ratio. It is also known as liquid ratio. So where exclusively we used to consider the liquid assets to that of quick liabilities. And third one, absolute quick ratio. So where we used to consider highly liquid ratios, liquid assets to that of current liabilities, that is known as absolute quick ratio. Then second type of ratios are capital structure or solvency or leverage ratios. It is a key metric used to measure an enterprise's ability to meet its long-term debt obligations and is often used by prospective business lenders. A solvency ratio indicates whether a company's cash flow is sufficient to meet its long-term liabilities and thus is a measure of its financial health. So the most commonly and widely used ratios of capital structure or solvency or leverage ratios are debt equity ratio, which can be computed by using the formula debt equity ratio is equal to long term debt divided by shareholders fund, or it may also consider a ratio of external equity to that of internal equity. And second one is proprietary ratio, which can be computed by the formula proprietary ratio is equal to shareholders fund divided by total assets. Third one, interest coverage ratio is equal to earning before interest and taxes, which is known as EBIT divided by fixed interest charges. And fourth one, debt to total funds ratio, which is equal to debt divided by total funds. And third category is turnover or activity ratios. So these ratios are also known as efficiency ratios and which are used to evaluate how efficiently a company uses its assets and liabilities to generate sales and maximize profits. The key efficiency ratios include turnover ratio, inventory turnover, and days sales in inventory. So, inventory or stock turnover ratio, which can be derived by using the formula cost of goods sold divided by average inventory at cost, or sales divided by average inventory at selling prices, or sales divided by average inventory at cost. So it depends on the type of information furnished in the problem. Based on that, we have to use appropriate formula. Then second, debtors turnover ratio. So which can be computed by using the formula net credit sales divided by average debtors. And how to find out average collection period. If you want to get the average collection period in terms of days, within how many days you are going to collect the payments or any other things from various stakeholders. So that can be derived with the formula debtors to the of credit sales into 365 days. Then creditors turnover ratio is equal to net credit purchases divided by average creditors. Working capital turnover ratio. It can be derived by using the formula cost of sales divided by net working capital. So net working capital it can be calculated. It is the difference between current assets minus current liabilities. So that is known as net working capital. Then in the same manner we have to calculate fixed asset turnover ratio, which is equal to cost of sales divided by fixed assets at cost less accumulated depreciation. And next one, capital turnover ratio is equal to cost of sales divided by capital employed. Then fourth category is profitability ratios. So these ratios convey how well a company can generate profits from its operations. Profit margin, return on assets, return on equity, return on capital employed, and gross margin ratios are examples of profitability ratios. So the formulas given as follows: gross profit ratio is equal to gross profit divided by net sales into 100, or gross profit can be derived by using the formula net sales minus cost of goods sold divided by net sales into 100. And second one is net profit ratio, which is equal to net profit divided by net sales into 100. Operating ratio, cost of goods sold plus operating expenses divided by net sales. Operating profit ratio, it can be calculated by the formula operating net profit divided by net sales into 100, or 100% minus operating ratio. The next, expenses ratios. For cost of materials, the formula is materials consumed divided by net sales into 100. For selling expenses, the formula is selling expenses divided by net sales into 100. The next one, return on investment ratio ROI, which is equal to net profit before interest and taxes divided by total capital employed into 100. Then returns on shareholders fund, it can be derived by the formula net profit after interest and taxes divided by shareholders funds into 100. And return on equity share capital is a ratio of net profit after interest, taxes and dividend to that of equity shareholders fund multiplied with 100. The next one, EPS, earning per share, which is equal to net profit after taxes minus preference dividend divided by number of equity shares, and dividend payout ratio can be calculated by the ratio dividend per share divided by earning per share. The next one, price earning ratio, which is also denoted as P by E ratio, which is equal to market price per equity share divided by earning per share. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.